Crypto is eating TradFi's lunch. Now, if you've been following crypto for more than 5 minutes, you'll know that one of the industry's oldest promises was that it would one day come for TradFi. And thanks to tokenized real-world assets, or RWAs, that promise is now being fulfilled. Stocks, commodities, bonds, even pre-IPO equity are moving on-chain. What we're seeing is the core architecture of Wall Street being rebuilt on crypto rails. And if that sounds like a dry, institutional corner of crypto that doesn't concern you, think again. Sure, RWAs might lack the excitement of uncovering an altcoin gem with groundbreaking tech or a meme coin that could 100x your portfolio overnight. But make no mistake, RWAs are growing faster than any other sector in crypto, and the numbers are truly wild. According to a recent CoinGecko report, the total market cap of tokenized RWAs has more than tripled since the start of 2025, surging 256% from $5.4 billion to $19.3 billion by the end of Q1 this year. That is no small shift, especially when the rest of the crypto market has been pretty meh during that time. But this isn't all that surprising when you consider how much development the RWA sector has already seen. Just look at tokenized stocks. They basically allow investors to trade the traditional stock market, but without the usual limits. No jurisdiction limits, no 9:30 a.m. to 4 p.m. Monday to Friday restrictions. With tokenized stocks, you can buy shares of Apple or Tesla at 2 a.m. on a Sunday, if you so wish. Anyhow, the latest wave of tokenized stocks is relatively new, having only launched in mid-2025. And since then, their market cap has exploded from just $2 million at launch to $486 million by the end of Q1. That kind of growth is hard to wrap your head around, yet under $500 million means this sector is still just getting started. But market cap only tells part of the story. Zoom in on spot trading volumes and you'll see tokenized stocks hit $15.1 billion in Q1 alone, beating the $14.8 billion traded across the entire second half of last year. In other words, trading momentum has doubled, showing real demand. Another major draw to crypto is tokenized treasuries. They take the safest investment vehicle around, make it far more accessible, and let it trade 24/7. At the start of 2025, their market cap sat at just $4 billion. By the end of Q1, it had climbed to nearly $13 billion. That's growth of 225%. And then there are tokenized commodities, up roughly 290%, from $1.4 billion at the start of last year to over $5.5 billion by the end of Q1. Nearly 90% of that comes from tokenized gold alone, largely driven by gold's recent price rally. Even so, spot trading of tokenized gold hit $90 billion in Q1 alone, topping the $84 billion traded across all of 2025. That is truly mind-blowing. But all this is nothing compared to RWA perpetual futures, which saw volumes hit over $524 billion in Q1 of this year alone, which is crazy when you consider just $313 billion was traded throughout the entirety of 2025. This not only shattered records, but also marked the fourth consecutive quarter of growth, despite crypto's broader market downtrend. But if all of that wasn't already crazy enough, crypto is now providing ways to speculate in IPOs before they even go public. Platforms like Bitget's IPO Prime and fully on-chain projects like Hyperliquid are opening up ways for users to speculate on pre-IPO valuations. That used to be strictly venture capital territory. Now, though, anyone with a crypto wallet can get involved. But most importantly, the data shows that it's not just ordinary retail investors that benefit from TradFi's transition on-chain. It's being driven by institutions. And this makes sense when you consider the advantages blockchain offers over the legacy systems in place. 24/7 market trading hours, global liquidity access, fractional ownership of assets, instant settlement, and of course, a much larger pool of investors. Put simply, RWAs are no longer niche. What started as an experiment has quickly become scalable infrastructure driving real adoption. And that adoption will only keep growing as more of TradFi's infrastructure gets rebuilt on-chain. RWAs are evolving far beyond just another crypto narrative. In other words, they're becoming the very thing that flips TradFi on its head. So, if you're looking for the biggest opportunities in crypto right now, the RWA sector is where the action is. So then, if you're looking to trade tokenized RWAs and capitalize on this growing market, where can you start? Well, one of the best venues to use is Bitget. They've just rolled out their TradFi trading platform, which lets you trade traditional assets directly using USDT, so you don't need to jump between crypto and TradFi infrastructure. This means that you can use your crypto to buy tokenized Apple and Microsoft stocks. You can trade precious metals like gold and silver. You can trade commodities like wheat, coffee, and orange juice. You can trade the euro against the Turkish lira on the Forex market. You can buy tokenized shares in stock indices like the S&P 500. You can even trade contracts for difference, or CFDs, or perpetual futures contracts. And best of all, you can do all this without ever leaving the blockchain ecosystem. Oh, and remember how I mentioned the possibility to trade IPOs before they go public? Well, Bitget has you covered there too with IPO Prime, an awesome place where you can find pre-IPO investment opportunities before they go parabolic. Now, throughout all of this, you get deep liquidity, low slippage, and access to up to 500x leverage. And right now, if you sign up using the QR code on screen or the link in the description, you can also get up to $50,000 in bonuses. And on top of all that, if you complete your first net deposit of $5,000 and place your first trade, you'll instantly unlock a VIP 3 trial. That includes fee discounts of up to 38%, exclusive VIP perks, and free token airdrops. Yes, you heard that right. Free crypto. It doesn't get much better than that. So, what are you waiting for? Scan the QR code, check the link below, and see what Bitget has to offer. Okay, now, by this point, you know why traditional assets will benefit from being tokenized on-chain. But what you might not realize is that there's something much deeper happening here beneath the surface. This isn't just about the transfer of real-world assets onto blockchain infrastructure. It's more about power in the financial sector being transferred to crypto. Now, many don't fully grasp how power actually works in financial markets. It's not about slick interfaces like Robinhood or JP Morgan's mobile banking app. The real power lies in the boring stuff, the plumbing underneath it all. It's the infrastructure that everything depends on. And whoever controls that basically controls how markets actually function. For years, crypto's answer to traditional finance was to build parallel systems. Decentralized exchanges, permissionless lending protocols, blockchain-based settlement layers, and crypto wallets were all designed to run alongside TradFi rather than through it. But if the recent surge in RWAs has proven anything, it's that something has shifted. Crypto is no longer just building alternative plumbing. And case in point, crypto exchange Bullish now has an agreement to acquire Equinity for $4.2 billion. And if your first response just now was, what the heck is Equinity? Well, that's kind of the point. For context, Equinity is a leading transfer agent. It's not a small company by any means, and yet most people have never heard of it because that's exactly how infrastructure works. It's the plumbing that quietly exists in the background. So, what does Equinity actually do? Well, it maintains shareholder records for more than 2,500 public companies. So, when you own a share, Equinity is part of the system that says you own it. It also handles issuer services like dividends, corporate actions, and proxy voting, which serve as behind-the-scenes processes that keep public companies running. And on top of that, it processes around $500 billion in payments every year. So, in a nutshell, Equinity is the system of record for who owns what, who gets paid, and when. It's the machinery that makes public markets function. And crypto just bought a huge chunk of it. But why would a crypto exchange want a deal like this? Well, it's simple. Because real power in finance doesn't come from building a better trading app, but from positioning yourself underneath the system that already exists. Owning infrastructure like this means owning control over settlement, records, and compliance workflows. Instead of disrupting TradFi from the outside, crypto is now absorbing it from the inside. And this makes sense because TradFi is desperate for better infrastructure. Margins are thin, regulation is expensive, and growth is slow. The plumbing simply doesn't allow for free-flowing markets. Many crypto firms, on the other hand, are flush with capital and operating with a shared long-term vision that the future of finance is on-chain. Over time, this completely reshapes the relationship between crypto and TradFi. So essentially, we're now entering a world where TradFi acts as the front end, the familiar assets and interfaces that normal investors are used to. Meanwhile, crypto is becoming the back end, the settlement layer, the record keeper, the plumbing that runs underneath. Now, by this point, you may be thinking that the idea of trading traditional assets on-chain is nice, but won't make much of a difference in the grand scheme of things. And you'd be forgiven for thinking that way. After all, legacy financial markets have stood the test of time and aren't exactly going anywhere. But here's a scenario worth considering. It's 3 a.m. on a Sunday. Geopolitical tensions have just escalated and oil supply is now under threat. Everyone wants to buy gold as a safe haven, but every major stock market is closed. You can see the news, you can read the analysis, you know which assets will likely crash and which ones will rally. But you can't do anything about it until Monday morning, by which point the rest of the world rushes to reprice everything at once. Now, this is the fundamental flaw of TradFi. The most important markets in the world still run on a 9-to-5 schedule. Stocks, bonds, and commodities are subject to set trading hours. Exchanges close on nights, weekends, and public holidays. For a system that manages trillions of dollars, that structural weakness is honestly pretty staggering. But, as we know, crypto offers a better solution. In fact, there's evidence of this already happening on Hyperliquid. Back in February, when the US and Israel started dropping bombs on Iran, investors everywhere were speculating on the price of oil. As a result, trading volumes of oil futures on Hyperliquid skyrocketed to $1.7 billion, 250 times higher than before the conflict escalated. And it's not just oil. Precious metals futures on Hyperliquid also saw major activity during times when traditional markets were closed. Similarly, TradeXYZ, a protocol built on Hyperliquid that offers equity and commodity perpetuals, currently has over $2.2 billion in open interest. And these contracts are being traded constantly, even when legacy venues are sleeping. This underscores something that's impossible to ignore. 24/7 global events demand 24/7 markets. Retail and institutional investors are growing tired of using outdated systems with centralized bottlenecks and restrictions. But by replacing legacy infrastructure with crypto infrastructure, they have the freedom to move capital whenever the market demands it. And this is a bigger deal than you might think. By enabling continuous price discovery, markets naturally become more efficient. Traders don't have to sit on unhedged risk all weekend, hoping nothing blows up before Monday morning. News events get priced instantly, not in a panicked frenzy when the market opens. Now, this is a huge advantage over TradFi rails, which suffer from set hours, limited access across time zones, and restricted leverage. Plus, if there's a major news event over the weekend, your risk is often locked in until Monday. But put that exact same market on the blockchain and you unlock 24/7 liquidity with everyone around the world participating on the same clock. Now, if there's one type of RWA that's performed exceptionally well, regardless of market conditions, it's stablecoins. For those unaware, stablecoins are classed as RWAs because, well, they're essentially tokenized versions of the currency backing them, in most cases, the US dollar. Of course, that doesn't mean that stablecoins are particularly exciting. Far from it. I mean, nobody is holding Tether's USDT expecting it to 10x. But while they lack the hype and viral moments, stablecoins are doing their job well, serving as critical infrastructure that upgrades the way that money moves. As we've seen, we're now entering a world where assets are rapidly moving on-chain, everything from stocks, bonds, commodities, and real estate. But you can't have 24/7 markets settling in assets that take 3 business days to clear. The money flowing through these markets has to move at the same speed as everything else, or the whole thing is pointless. The biggest fintech giants are hyper-aware of this too, and have been actively integrating blockchain into their core business models. And perhaps the biggest standout here is Visa, one of the most conservative, risk-averse institutions in global finance. A company whose entire business model is built on legacy payment rails. In September last year, Visa saw an opportunity to maintain its market dominance by expanding how it integrated stablecoins into its infrastructure. Notably, Visa pointed to the Genius Act as a key turning point, with the company's head of product saying, quote, "It made everything so much more legitimate." Before that regulatory clarity, all the big institutions were sort of on the fence. By November, Visa announced a stablecoin payout pilot, allowing platforms and businesses in the US to send payments directly to stablecoin wallets rather than a card or bank account. And safe to say, it's been a big success. By the end of April this year, Visa's stablecoin settlement pilot reached a $7 billion annualized run rate, up 50% from the previous quarter. The company also announced it had added support for another 5 blockchains, bringing the total to 9 at the time of shooting. And for anyone wondering, those 9 chains, in alphabetical order, are Arc, Avalanche, Base, Canton, Ethereum, Polygon, Solana, Stellar, and Tempo. Of course, Visa is just one of many examples of fintech companies adopting stablecoins. Other notable examples include PayPal's launch of its own PYUSD stablecoin, which appeared in August 2023. That stablecoin now has a market cap of over $3 billion. Another example is Stripe, which acquired stablecoin infrastructure layer Bridge in February last year for $1.1 billion, which remains its largest acquisition on record. Elsewhere, Revolut has found a way to attract new users by offering one-for-one conversion rates for stablecoins, letting users swap US dollars for USDT or USDC without paying any fees. The company also has its own stablecoin based on the Great British Pound, currently being tested in a sandbox set up by the UK's Financial Conduct Authority. Now, here's the significance of all this. This isn't just an idea of what could happen in the future. It's happening now. Real value is moving in real time on public blockchain rails. Stablecoins are being used as actual settlement assets by the most established payments companies on the planet. But what companies like Visa are really saying, whether they phrase it this way or not, is that crypto rails are faster, cheaper, and reliable enough for use at mass scale. In other words, it's TradFi admitting that crypto infrastructure is superior. But to understand the big picture, you have to zoom out and see stablecoins for what they are. Not just a useful crypto tool, but the monetary layer of an entirely new financial system. Think about everything we've just covered. Trading is happening on-chain, equities and commodities are being tokenized, markets run 24/7, and underneath it all, powering everything, are stablecoins. Compare that to how money moves in the legacy system. TradFi payments are restricted to banking hours. They depend on correspondent banking networks. They often carry delays, fees, and layers of intermediaries, each one adding new layers of friction and cost. Cross-border transfers that should take seconds can take days. And to make things worse, the whole system powers down every evening and every weekend, just like the markets built on top of it. Given the technology in the world today, it seems kind of ludicrous that this is just accepted as the norm. But stablecoins have none of those constraints. They're available 24/7. They're borderless by design. They're programmable, meaning they can be embedded directly into smart contracts, automated settlements, and DeFi protocols without any manual intervention. And they reach final settlement in minutes, if not seconds, instead of days. No wonder so many institutions are so desperate for them. Okay, now that we know just how important tokenization is for both crypto and TradFi, you might be wondering what else can be tokenized on-chain. And the answer is simple: everything. This is something that BlackRock CEO Larry Fink has explained with great enthusiasm. And when the largest asset manager on Earth tells you where finance is heading, it's probably worth paying attention. The most powerful allocator of capital in the world believes that everything will be tokenized. So this isn't some crypto maximalist speculating on crypto-native assets. No, this is the CEO of the world's largest asset manager foreseeing stocks, bonds, funds, and other real-world assets being represented digitally, settled on-chain, and traded globally. Most people thought that with the growing attention on ETFs, regulation, and involvement from Wall Street, TradFi was taking over crypto. Many believed that the suits had arrived and the crypto dream was being dismantled before our very eyes. In reality, though, something close to the opposite is happening. Crypto isn't being absorbed by TradFi. TradFi is being absorbed by crypto. Look at everything we've discussed today. Crypto firms are buying TradFi's core infrastructure outright: the settlement systems, the shareholder records, the payment processes. 24/7 markets are already running on-chain for oil, gold, equities, and major indices, while legacy venues sit dormant overnight. Stablecoins are settling real institutional value, and weekend price discovery is happening on-chain. Importantly, though, we're not saying that TradFi is going to disappear. Asset managers aren't closing up shop. Regulators aren't going away. Banks won't just vanish. But the infrastructure is changing. Crypto doesn't replace the system, it becomes the foundation it runs on. It becomes the base layer, not the rebellious alternative. That is a profound shift in power that shouldn't be understated. For years, everyone assumed crypto needed TradFi to survive, that it needed institutional legitimacy, regulatory approval, and Wall Street's blessing. And maybe that was true once upon a time. But as it turns out, it was TradFi that needed crypto to evolve beyond infrastructure built for a pre-internet world. So, there you have it. Global finance is being rebuilt in crypto's image, and lunches everywhere have been eaten. And yet, the appetite is only getting stronger. And that's about all from me for today, folks. But, well, what do you think? Are you feeling bullish, or do you feel this is a sign that crypto has lost its way? Let us know your thoughts in the comments below. If you want to learn about how Stripe and Coinbase could break banking forever, then check out the video over here. And if you want to see how Wall Street was wrong about Bitcoin, then check out this video right here. Okay, thank you all so much for watching, and I'll see you again soon. This is Guy, over and out.